I am very bullish precious metals as we speak. I mean, I think this little pullback, the sharp pullback we had is over, and I think silver can go to 100 here pre-bust. Gold can go to 5,000 pre-bust, and I think I'm probably conservative there. During the bust, I think almost all assets other than treasuries get hit. Post-bust, I'm calling for 20,000 gold and 500 silver, probably in the early 2030s. If inflation does what I expect, precious metals are going to be the top game in town. By the way, I'm also calling for $500 oil by that time.
The precious metals landscape is entering one of its most pivotal periods in decades as macroeconomic pressures intensify across global markets. With structural inflation rising, sovereign debt swelling, and liquidity risks appearing beneath the surface, gold and silver are positioning themselves as the primary beneficiaries of the coming economic realignments. Silver's pre-bust potential toward triple-digit levels and gold's trajectory toward the $5,000 range reflect a broader shift. Investors are waking up to the reality that traditional assets may fail to protect capital during the next significant downturn. As equities approach what may be a secular peak and debt markets face historic stress, capital is seeking refuge in tangible monetary assets with a centuries-long history of reliability. Macro strategist David Hunter, known for his long-cycle framework, argues that while a significant bust phase may temporarily drag all assets lower, the post-bust rebound will ignite a robust secular bull market in precious metals, potentially driving gold toward $20,000 and silver toward $500 in the early 20s to 30s. His outlook emphasizes the changing market leadership, the long-term decline of the dollar, and the outperformance of quality miners as capital shifts into tangible assets. Now, we present the clips from David Hunter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I am very bullish precious metals as we speak. I mean, I think this little pullback, the sharp pullback we had is over, and I think silver can go to 100 here pre-bust. Gold can go to 5,000 pre-bust, and I think I'm probably conservative there. During the bust, I think almost all assets other than treasuries get hit. So, as I say,
your winners.
You have to be careful that you're not standing on the south rim of the Grand Canyon looking across the north rim and thinking you can just hold these things right through, because there's a canyon in between. But post-bust, I'm calling for 20,000 gold and 500 silver, probably in the early 2030s. If inflation does what I expect, precious metals are going to be the top game in town. By the way, I'm also calling for $500 oil by that time. So that's another reason why this is going to be a secular peak in the stock market. If it goes to 9,500 or 10,000 or 9,000, wherever that peak is, I think that peak will stand for decades. Well, for example, the miners in bull markets usually outperform the metals. And I think that will hold true in the post-bust period. So if silver goes from, let's say it goes to 100 pre-bust, goes down to maybe 40 or 30 in the bust, and then goes to 500, so it's, a 15-fold increase, let's say, miners probably have a bigger increase than that, at least the good miners. So there'll be plenty of opportunities in stocks, but the indexes, the broad indexes like the S&P and the NASDAQ and the Russell, et cetera, keep in mind how the math works. At the top, they're heavily weighted in this cycle's winners, right? So technology's heavily weighted, energy's 3% of the index or whatever. But coming out of it, you'll still have the heaviest weightings in the sectors that were last cycle's winners, and the lowest weightings in the things you should own. So that means if you're a passive investor, your portfolio's upside down. You're buying the wrong things. By the end of the cycle, it'll be flipped, and energy will be the top of the index. It will be the heaviest weighted, or commodities will be. Industrials will be heavily weighted. Technology will probably be somewhere in between, because we'll still be seeing AI and other technological things winning. But overall, growth stocks will be hurt very badly by rising interest rates. Consumers are not going to be in good shape after getting hit hard in the bust and then facing inflation. Real estate's not going to be doing all that well because mortgage rates are going to go through the roof. So your price of your homes are probably going to be down, et cetera. So utilities, probably won't be doing well because they're more tied to their dividends. You'll have some growth in the demand for energy, but and so you go across the board, and basically, as I've known through my 52 years of doing this, every cycle has different leadership. And if you stay with the old leadership, you end up regretting it. I'm calling for a dollar down to 82, but I think most of that happens pre-bust or in the early stages of the bust. I think we'll see the traditional run to the safety of the dollar during the worst part of the bust. In spite of, because don't forget, we're not printing in a vacuum. Every central bank's going to be printing proportionally similar. So the dollar, I think, goes to 82 first, but then goes from 82 to 120 in a flight safety. And then post-bust, dollar, I think, could go to 50 over time, over 10 years or over 7 or 8 years. So I'm not at all a bull on the long-term bull on the dollar. I think what we're doing is, we're going to be in trouble, and we are the biggest out there in terms of, we're the ones that have to bail everybody else out, or the Fed does more than anybody else. All that's fine in the short term, but ultimately it's going to lead to us having the biggest problems too. Certainly. And the other thing people will say is a lot of that leverage is sovereign leverage. It's government debt. So, governments have printing press and things. So I don't think we have a sovereign crisis this time. I do think that gets kicked down the road until the next cycle. And then the collapse is a sovereign collapse. But there are areas. I mean, certainly commercial real estate is one area. Certainly private credit. As I say, when back in the mid 80s, we called private equity leveraged buyouts, right? Now it's been renamed to private equity. It sounds nicer, sounds more benign. It's still very leveraged companies. So you've got that, junk bond area. You've got, I think because of the pandemic, you've got a lot of fragility in the system and beyond leverage as well. That, small businesses are certainly not on the same strong footing they were pre-pandemic in many cases. So I just think you've got the combination of very high leverage around. And it's true. Consumers, certainly many consumers are on a macro basis, consumers are less leveraged than 2008-9 for sure. Banks in this country are less leveraged than they were back then. But I think banks around the world are more leveraged. Canada didn't learn our lessons of 2008-9. They were in great shape then. They're in terrible shape now. Your banks, I think, are in bad shape. Certainly we know Asian banks are in trouble. So I do think there's plenty of leverage that's private leverage that can come to the fore and create a problem. My view is not by any means a consensus view or the institutional view. So, and there'll be a shortage of yield. There'll be a shortage of returns. If I'm also calling as an accompaniment to the bust an 80% bear market. So if the stock market's going down 80% and short rates are going, negative, you're going to be glad to get 2% or 1% on your 10-year because you have no return anywhere else. Not to mention the biggest reason we'll get to zero is to get 20 trillion, whatever the number is, into the system. The Fed will be buying every bond inside, every treasury
forced
bond.
buying, and the banks will have to.
So they'll be the buyer of last resort. I have kind of laughed at all the worries about where's the foreign buying and what's going to happen when China doesn't buy our bonds, and et cetera. That may be an issue down the road, but it's certainly not going to be an issue next year. So you can understand that treasuries will be one of the very few things to protect capital in a downturn. So it would make sense to have a pretty heavy weighting in treasuries to weather the storm. It would make sense in my scenario, if I'm right, to not be a buy and holder and think that we always go to higher highs, because I really mean that. I think the highs we make in the next few months, or if it is a few months, will probably stand for decades. And so, again, we've brought investors up on this whole idea of markets always go to higher highs. And, because of printing money, it always works out that at least in nominal terms, markets go to higher highs. And I just think we're at that turning point where that's not going to be true. So buy and hold is probably not the best strategy going forward. If you are going to buy and hold, recognize the changing leadership and look forward to that. Because if somebody chooses, and I can't say they're wrong, to say I'm not smart enough to pick the top and bottom of gold and silver, I'm going to just ride it through, you'll be fine because they're going to much higher highs, in the next cycle. But if you're in, Procter & Gamble, good luck. because Procter & Gamble is going to struggle in an environment where interest rates go to 15 or 20% and inflation goes to 15 or 20%.
Market momentum is shifting into one of the most powerful phases seen in decades, with price action positioning itself for a parabolic advance despite widespread skepticism. Even after the recent pullback, sentiment remains deeply cautious, creating the classic backdrop for an explosive upside move as institutions, which have spent years doubting the rally, are now being forced to chase performance. The combination of easing monetary policy, still strong earnings, and rapidly falling interest rates is building the foundation for what could become one of the most significant melt-up phases in modern market history. As liquidity expands and long-end yields decline, asset prices can be pushed higher with surprising speed, especially once fear of missing out overtakes the caution that has dominated institutional positioning since 2022. Beneath the surface, the economy is weakening, with recession risks already embedded despite headline GDP strength. As policy rates move lower and the slowdown deepens, the stage is being set for a powerful rally that may disguise the underlying fragility. The real shock emerges later, as the anticipated downturn accelerates into a full-scale bust. Once the cycle breaks, the path forward shifts dramatically toward crisis-driven intervention and massive global stimulus. Let's get back to the interview.
I think it's going to go parabolic here in coming weeks. So I know people have reacted to the recent sell-off and started talking about a top and getting a little more bearish, but I see it as it's amazing. The sentiment is still very skeptical, still very cautious, and yet we're at all-time highs or very close to all-time highs. So that's the kind of setup, I think, for what I'm describing, which is, probably the biggest rally in history, in my opinion, over the next couple months. Big-time contrarian, so sentiment is a big part of my work. And there just is tremendous caution, particularly on the part of institutions. As I've said, and I was bullish in October of 2022 and said we're taking off. Back then I was calling for 6,000. I've raised my targets several times. But all the way up here in the last 3+ years, institutions have remained cautious, have had, as I've said, have had one leg out the door, kind of thinking valuations are high, this thing can't go much farther. And they've reluctantly kind of gone along with the momentum. But I think they're about to turn more bullish. You're starting to see it. And I think what you're going to hear in the next few months is that with the Fed really beginning an easing cycle, that you may have a couple of years to run. I don't believe that. I think we're going to see a top in a matter of months. But I think what will drive this is the feeling that, hey, this is, we've got a lot more road ahead, that with the Fed easing, earnings are going to pick up and the economy is going to pick up again. I think that's a part of it. I also think the bond market looks great here. With or without the Fed, I think rates are going to come down quite significantly. So again, I'm contrary to, I think, most of the street, but I think even the long end, I think, is going to do very well here. So lower rates, still very good earnings, and the Fed's easing and wind at your back, I think can help propel this. And then, of course, you add on to that the need for the institutions to catch up, so FOMO will play a role here. If you go back, I started in this business in 73. So if you go back to 74, or you go back to 1982 or the early 2000s or 2003 or 2009, those are all beginnings of cycles where the Fed was at your back. They were easing. The economy was not doing well when those markets bottomed and took off. The difference this time is we're at all-time highs, and we're going to get that. So I am actually predicting we could be in recession already. We certainly have a have and have not economy. So more than half the economy is people struggling to just meet their daily needs. But the wealth out there and the other half of the economy, or certainly the top 20% of consumers, are still spending because they have a lot of equity in their homes. The market's at all-time highs, and they're doing well. So I think under the surface, even though you get a GDP number that says we're close to 4%, under the surface, you could actually, when they go back and date a recession, which they do after the fact, the NBER very often dates it, and it's earlier than you ever thought it was. So I would not be surprised if it gets dated prior to now. So we may be in recession already, and if not, we're definitely slowing. But with the Fed easing, and I think going to have to get more aggressive easing in the months ahead, that's going to at least initially propel the market. I am expecting 2026 to be a pretty negative year. In fact, I'm calling for a global bust. So if we are in recession or if we're moving towards a recession, I think that recession will morph into a bust. And I define a bust as something worse than a normal recession, but not as long as a depression. So it'll happen in the speed of a recession, so 12 to 18 months long, but it will be accompanied by a big financial crisis. So it's a lot like 2008-9, except I think it could be bigger than 2008-9 because leverage this time around is so much higher than it was back then. We've got 330 trillion in global debt. We know what our debt is here in the U.S. in terms of government debt, but we also have tremendous leverage in the system throughout the world. And we know from business school, leverage works great on the upside. It enhances returns, allows people to do well. But in the downturn, leverage really exacerbates the downturn. So I think it's going to hit banking pretty hard. I think we could see bank failures domino across the world. I think what makes this worse than 2008-9 is we pulled back from the cliff then. As you say, the wheels almost came off when the commercial paper market froze and the rumors were around the GE was going under. That was when the government finally stepped in and said, we got to do a lot more. And it pulled us back from the cliff. This time around, partly because of 2008-9, I think particularly the central banks, but also the government, is going to be reluctant to go that far again. And they will have to, and they will, but it's that pause or that hesitation when things are unraveling in a deleveraging, that happens very quickly. So even if you are, a month or two late, it can lead to things going over that cliff. So my guess is the Fed will be easing here, but getting to a right-sized policy, if this thing is moving ahead of it so that it's starting to unwind and they're lowering rates, but they're reluctant to print money. So, and then when they print money, they say, but we're not going to do the printing we did last time. We're not going to do 5 trillion like we did in 2020. And we're not going to, go crazy with money. We're not here to bail out the stock market. That hesitation, it's during that period of time that things can really hit the skids. Even Wall Street is telling the Fed, don't do what you did last time. Wall Street does not think big money is a solution. And by the way, I should say, this is not an endorsement. I'm not saying this is a good policy or a bad policy. I'm just saying this is inevitable. Ultimately, if they, I think what leads up to is that they're reluctant to do what they did last time. But ultimately, they will have to do it. And when they do finally do it, the unwind that's happening right before their eyes will mean, I'm estimating, you could see 20 trillion come out of the Fed in QE. So we did 3.7 over a course of a few years following 2008. We did 5 trillion in the pandemic. This could be 4 times that. And probably 50 trillion around the world when you look at all the central banks having to do the same thing. So we will, I think that's the easiest prediction I can make is what will ultimately happen. How we get there is the harder part, is how bad it gets before, the deer in the headlights moment comes where they say, hey, forget what we should do or shouldn't do. We got to do this or else the system's going to just collapse. So they will save it. And that's why I call this a bust and not a depression. As long as they have the printing process. And by the way, I think the bust will mean we're heading into deflation short term. So by the end of 2026, we could be in negative inflation. In negative inflation, the Fed will have no concern about inflation. They'll be concerned about saving the system. That means you can print money infinitely, almost infinitely, because of leads and lags to when that will then reflate things is, well, probably 9 months to the economy and maybe 18 months to inflation. So they'll be dealing with the here and now and not worrying about, well, if we print this money, it's going to be inflationary. So ultimately, they'll do whatever they have to do to save the system. And that kicks the can down the road one more time, even though it's going to be a pretty ugly year or 12 to 18 months. You will have a recovery. You will have another cycle. And then I think by the mid-30s, you'll have hyperinflation. And probably before that, probably early 30s, have hyperinflation, deficits through the roof, debt through the roof, and you can't solve that equation and things collapse.
As this cycle accelerates toward its defining phase, the signals are becoming impossible to ignore. Markets are pushing into territory that reflects the final stretch of a long expansion, where momentum outpaces skepticism's ability to keep up the underlying fragilities. Debt saturation, tightening liquidity, and delayed policy responses are building pressure beneath the surface even as asset prices climb. This contrast is precisely what creates the dramatic shift from meltup to breakdown, the transition that catches institutions off balance and forces capital to rotate into tangible assets and protective strategies. Precious metals, long-term commodities, and defensive positioning become essential as the broader system enters a phase of stress that unfolds quickly and resets the entire landscape for the next decade. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.